Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello, welcome to today's Savant webinar. We're going to be discussing taking stock in elections, unveiling the market's political dance. My name is Dennis Covington, and I'm an advisor here in Savant's Atlanta's office. And joining me today is Apollo Lupescu, Vice President at Dimensional Fund Advisors. Dimensional is one of the premier investment managers in the world, managing around $750 billion in assets. Apollo is a globally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individuals on various investment topics. I consider Apollo to be the secretary of explaining stuff because he has always had a knack for explaining complicated issues in a clear and understandable way. Apollo, appreciate you joining us today.
Well, hi, Dennis. Thank you so much for the invitation. And thanks to everyone for taking the time to attend this very timely webinar on the elections and politics.
Yeah, well, one more fun fact about Apollo is prior to joining Dimensional, he taught at the University of California. He has his PhD in economics and finance from UC Santa Barbara, and he holds a BA in economics from Michigan State, where I think it's very interesting that he competed and coached in water polo. And rumor has it that even to this day, he still enjoys playing. And because he enjoys the water so much, he's even taken up learning to surf. So I think that's a fun, interesting fact, Apollo.
It is. Anything that has to do with water, I'm in.
That's great.
Even the hot tub.
Yeah. Before we dive into our topic, I wanted to provide some background on Savant. Savant is a wealth management firm that has more than 500 team members, 200 financial advisors. We're in more than 15 states today, and our whole goal is to walk alongside our clients and help them navigate life's financial journey. We are an employee-led, majority-owned company that's independent, that wants to provide a one-stop holistic wealth management solution for our clients and help them navigate all these topics. And, you know, like the topic we're going to be discussing today can have a lot of impacts on how you think about a lot of different things along life. And our whole vision is to help our clients achieve their ideal future, however they define it. I just wanted to give you a little overview of Savant before we dive into today's topic. I'll stop sharing and bring Apollo front and center. And Apollo, if it's good with you, we'll jump right into some of the questions I have.
Let's do it.
All right. So investors across the country are anxious about the upcoming election. They have concerns ranging from autocracy in some circles to taxes and government regulations in others. So how do you think investors should think about the concerns in the context of their investments?
Yeah, I know it's a great place to start because over the past few weeks, I have traveled the country meeting with all kinds of folks in different regions. And in some parts, perhaps there is a more conservative leaning and others more liberal. And I found there is anxiety pretty much everywhere. It doesn't matter where you go. People are anxious about something. If it's a conservative area, perhaps they're concerned of what if somebody with a more socialist view comes in the White House, taxes, regulations. In other parts, they look at the progressives and say, well, what if we have an autocrat coming in and democracy doesn't hold up as well? And there's all kinds of chaos that's going to be unveiling. So I'm here to tell you folks that these anxieties are real, and it's not just you, and it's pretty much across the country. Even though they're all good people, it is something that is impacting us. And I think that this anxiety comes from the fact that the politics and elections in general, they do touch on our deeply held beliefs, our core identity as individuals. And because of that, they tend to trigger these very strong emotions. And I think it's perfectly fine to have them because that's what makes us human. And it's also perfectly fine to act upon them the right way. At the very least, vote. We live in a free country. We can go have cast a vote. Let's go vote. You can get involved in a political campaign. When it comes to investments, what I've seen in my entire career over the past 20 plus years is that really successful investors are able to honor and acknowledge these emotions and at the same time disentangle them from investment decisions. and make sure that when they decide what to do with their money, it's on much more pragmatic reasons, such as data and the evidence and what do numbers say rather than how we feel emotionally. So the first consideration here is an acknowledgement of the emotions and say it's perfectly fine to feel them. At the same time, to really make sure that you as an investor know that the really good ones are the good investors are being much more pragmatic rather than invest based on their feelings. And in that respect, if you think about the stock market, well, the stock market is about ownership in companies. And the function of the stock market is to facilitate the buying and selling of ownership in different companies. And at the same time, to assess how much is it worth to have a piece of a company? How much is it worth for me to own a little bit of Microsoft or Google or McDonald's or Coca-Cola or Delta Airlines right here in Atlanta? And that's what the function is. So in that respect, a lot of these issues that are front and center in an election, civic rights, reproductive rights, all of these, they're very emotional. And at the same time, you have to ask yourself, how much are Coca-Cola's earnings impacted by a lot of these issues that are much more civic in nature rather than market in nature? So what we find over and over is that these very tangible way in which a politician or a government can impact earnings, they don't relate as much to the big front and center issues that might be in a political campaign. And the last point, beyond the ones that I made so far, is that one of the things that Dennis pointed out in the last slide is that everybody working with Savant has a financial plan. And that financial plan takes account of their needs, their circumstances, their risk capacity, and has a certain balance between different investments. Ownership in stocks is one category. There's a lending. You can lend your money at pretty fixed interest rates. And there's another category called bonds. Perhaps there's some real estate investment trusts. There are all kinds of different investments. And you might have a very specific allocation to each based on your needs and circumstances. And you might not be as heavily invested in the stock market as one might think, because you might even have international companies as part of your portfolio. So be mindful that what we're going to talk about the stock market today is not necessarily your investment portfolio. Your investment portfolios might be much, much broader than just what we discussed today.
Great, thank you. It seems these days that the government and the stock market are somehow intertwined.
Right.
And in that respect, it might be useful to think about it from a historical perspective. Is this a recent phenomenon, or is there evidence that the link has been present in the past?
Right. And it's so interesting, that is because as I traveled the country, I got this question weeks ago, and I don't know that I had a good answer. And I started to kind of dig a little deeper to figure out, well, how far back can we go to see this connection between private businesses and government? And what was fascinating is that I was able to go all the way back to the founding fathers, because if you look at Bank of New York, that bank was founded in 1784. So it's only about 8 years after the Declaration of Independence. And the reason I bring it up is it's a private business. And it had about 700 shares of ownership, and 1.5 shares of ownership belonged actually to one of the founding fathers, Alexander Hamilton. He actually wrote the charter for that bank. And the reason I bring in Alexander Hamilton going all the way back is because he was a member of the government. He was a founding father. And then at some point, he went into the private business of the Bank of New York. And the way it ties into the government is that in 1789, that's when the U.S. government took out its first loan. So if you don't know, when did the U.S. government start borrowing money? 1789. It was $200,000 roughly. And he went to pay the salaries of the members of Congress and George Washington. That's when we start borrowing money. And that loan came from the Bank of New York. And Alexander Hamilton had 1.5 shares of ownership. That loan generated an interest payment, and part of those profits that the bank made went to Alexander Hamilton. Nothing nefarious there, but there's a connection right there because Bank of New York was able to secure that loan from the U.S. government. And I'm not sure if you watched this, Dennis, or listened to the musical. My daughter loved it for years, and one of the things that I learned is that Alexander Hamilton had a nemesis, Aaron Burr, and it turns out that Aaron Burr also owned shares in the Bank of New York, twice as many as Alexander Hamilton. Out of the 700, Alexander had 1.5. Aaron Burr had 3 shares of ownership. And what's even more interesting is that if you had those shares of ownership from those days, they would be valid today because in 1792, Bank of New York was the very first stock ever traded on the New York Stock Exchange. And if you owned a piece of that company back then, 200 plus years later, you would still be entitled to part of the earnings. That bank still trades today as BNY Mellon on the New York Stock Exchange. So it's a very long track of this relationship between businesses and the U.S. government.
Very interesting. Maybe you should have added history to your PhD.
Curiosity.
Yeah, that's good. It's very helpful. So over the years, the federal government has been spending more money than it's been collecting in taxes, and in the process has needed to borrow more and more money. Last year, we confronted the debt ceiling. Congress just extended it a little bit into December to get past the election, and it's highlighting the concerns over this national debt. We've had dysfunctional politics, et cetera. So is our national debt sustainable, and how are investors assessing it? Is one candidate or one party better at handling this debt?
Yeah, and that's such an important question. Just to kind of give a sense, what's this idea of the debt? Well, every single year, the government collects certain taxes from all of us and has certain spending. And there are years when we spend more than we collect in taxes. That is called a deficit. To cover the deficit, to be able to spend beyond what we collect in taxes, the government needs to borrow. So when you add up the borrowing that the government has been doing, going back to the 200,000 that it took out back in the 1780s, what you see is that the beginning of this year, or the beginning of 2024, we owed as a country something in the order of about $34 trillion. That's how much we owed. It's a big number, $34 trillion. And this debt has been building up because if you go back to 1990, for example, in the early 90s, the level was roughly about $4 trillion. So over the course of the previous 30 plus years, we have significantly increased the level of the debt. So what's going on here? Well, the first thing to note is that the debt is building up on years and years of spending more than we collect in taxes. And why is it so hard to cut the spending? There are certain laws that mandate the U.S. government to spend money. And a prime example of that is Social Security and Medicare. There are laws on the books saying that we have to pay Social Security, or we have to pay for the health care of the elderly. And that amounts to about half of the entire spending of the government, just those two elements. But there are other elements that are called mandatory spending that, again, there are laws on the books that the government has to spend money. So when you put in those mandatory spendings that are set in law, you put in the defense, which is something that we know it's a necessary expenditure, and the interest that we have to pay on the debt, that builds up to about 80% of the entire spending on the government comes from mandatory spending, interest, and defense. So what's left is about a fifth for everything else, which means highways. We talked about highways and how necessary it is, not just to build them, but to repair them if something like a big storm would damage them. You talked about housing and urban development. You're talking about healthcare. There's so many other areas in which the government is helping, academia and education and so forth. So what it means is that whatever is really more discretionary to be cut, it's a much smaller piece. It's only a fifth. And then you have to say, what can we really cut? And in my view, a lot of these expenditures, and if you want to really make a difference, you have to go to some of these mandatory spendings, which are political decisions rather than economic decisions. So you asked, has one party been better or the other at handling those? Again, let's look at the numbers and see what the numbers are saying. In January of 2024, we owed, as I mentioned, about $34 trillion. And 3 years before that, when the current administration came in the White House in 2021, we owed roughly about $28 trillion. So over the course of the past 3 years, during the Biden administration, we added roughly about $6 trillion in debt, which means that per year is roughly about $2 trillion. So that's been sort of like we added $2 trillion per year in debt over the past 3 years. Now, when the previous administration came in, the Trump administration in 2017, the national debt was a little less than 20 trillion, but let's just call it 20 trillion to make it nice and even. So at that point, during the Trump administration, we added $8 trillion, and the majority of this was before the pandemic, 7 out of the 8, which means that per year, we added roughly about $2 trillion per year. So when you ask the question, is one political party better than the other? It doesn't appear so. It's just not. As much as they might be tooting their own horn, it doesn't appear that any one party is better or worse. And in fact, some of these proposals are likely to even increase the debt even more. So in that respect, how is the market considering this? It doesn't seem like any one party is better or worse, at least not in the data. So is this sustainable ultimately? And the way that the government borrows money today is no longer by going to a bank. No bank is big enough to give the loans that the government needs, but rather the government comes to Dennis and say, hey, Dennis, if you give me $1,000 today, we will write up a contract. We will specify an interest rate that you will receive for how long you get the interest rate. And at the back end, you're going to get your $1,000 back. That's what's called a bond. Now, when time comes to pay Dennis $1,000, the government can come to me and say, hey, listen, why don't you give me $1,000? And if I agree to those terms, then they can take my $1,000, give it to Dennis, and in effect, push this principle further and further and further down the road, almost indefinitely. So that number itself, 34 trillion, might not be the most meaningful way to look at the burden of the debt. But rather, the more meaningful economic burden is how much does it cost us as a country to pay interest on that debt? That, to me, is a true economic burden. And back in 1990, when we owed about $4 trillion, in fact, in 1991, we spent roughly about 3.1% of the value of the entire economic production of the country into paying debt, interest on the debt. So that was 3.1% in 1991 of the value of the entire U.S. economy paying interest on the debt at $4 trillion. Well, today we owe 34 trillion. How much can it possibly be now? Well, it turns out that as of the end of last year, the beginning of this year, we spent roughly about 2.4% of the value of the entire economic output into paying interest on the debt, which is quite interesting because even though we owe a lot more money, the burden today doesn't seem to be as great as the one in 1991. Well, how come? What's going on? What happened? Well, there are two things that are important to consider. The first one is the size of the economy today is significantly greater than the size of the economy back in 1991. In fact, the stock market back then was roughly about 4 trillion. Today, the stock market is roughly about 40 trillion, so a tenfold increase. So the economy, the stock market, everything's been going up. So the fact that the debt itself has gone up is not a terrible surprise. But the second big reason is that back in the 1990s, we paid pretty high rates on the government debt. And here, the bulk of the U.S. Debt right now has been accumulated in the last 15 years when the interest rates were rock bottom. And if you look at the Federal Reserve website that actually has this particular information, and I'll share with you a live website, what you see is that in the 90s, we saw this increase to got to the 3.1. And what this shows you is the interest as percentage of the GDP, the gross domestic product, the value of all goods and services produced in the US. That's what I've been talking about so far. And you see that it's been going up in the 90s to reach this peak of 3.1. And that's what people are very concerned about what's going to happen next. And what happened next, interestingly, was a decline. And in the 90s, Alan Greenspan, the Fed chairman, was thinking that if the government pays off its debt and doesn't need to borrow money, well, what are the investors going to do when they need this safe investment? And you know, even 3 years ago, in 2021, before the inflation came, even though we owed a lot of money, about 30 trillion back then, it was still less than 1.5%. It's just the past 2 years this has been going up because the government has to refinance the debt at a higher rate. So what's going to happen from here? It really depends on the interest rate direction. If the interest rates come down, that's going to benefit all of us. And perhaps that percentage is going to come back down. If it stays high, then that line might go back up. But ultimately, the question is, how are investors assessing this? What does it mean in terms of its sustainability? And if you look at the way that the government borrows, it cannot force Dennis or I or any of you to lend them money. It has to be a voluntary transaction. And in that voluntary transaction, I have to be okay with the interest rate that I receive on my money. And not too long ago, when the government wanted to borrow money for 10 years, the interest rate that they were willing to pay and investors were willing to accept was about 3.7% per year. It's also called the yield. Now, it turns out that the government is not the only entity that wants to borrow money. You know who else wants to borrow money? Mickey Mouse, Disney. So if you look at the interest rate that Disney had to pay to borrow for the same 10 years, it was higher. Instead of 3.7, was 4.3. And that's a pretty significant difference for an investor. And, you know, Disney would have loved to pay 3.7, but investors are saying, you know, as solid as you are, as robust as you are, you know, I just don't know that from a risk perspective, you are perceived as safe of an investment as the U.S. government. And you can go down the line. Another great American company, Ford, they want to borrow money. Well, they're paying more. It's about 5.7% for the same 10-year loans that they take through bonds. And Nordstrom, great retail store, they pay over 6.5% to borrow money. So, you know, the signal that we look at as investors is not how we feel, but rather when investors literally vote with billions and billions of dollars in accepting or not accepting certain interest rates, they're sending a very clear message onto how they think, how sustainable they think a debt is. And if they get a hold of data information that the U.S. government might not be able to sustain its debt, well, what's going to happen is you're going to see that reflected in the interest rate that investors demand as compensation for the risk that something might not be sustainable. And we have examples in other countries. For example, the Argentinian government is no longer considered to be as safe of a bet. And they can borrow money, but instead of borrowing as we do at 3.7, they have to pay over 16% to compensate investors for that perceived risk that I might not see my interest or money back at the end. So I think that to answer your question, Dennis, is the U.S. government sustainable? There are a lot of issues going on. You have to go beyond just the number, and you have to look at other factors. It's just that investors at this point, at this moment in time, they don't look at the government debt and say, it's unsustainable. What they're saying is, yeah, it's not pretty. And we still have more confidence in the U.S. government than any other borrower out there. So at least at this point, that's what the message is reflected in the yields that they are willing to accept, that investors are willing to accept.
All right. Thank you, Apollo. That covered a lot of ground, and we got a couple of questions while we were going through. And one of them was, what's the risk level associated with that debt? Which I think you just really detailed for us and want to reemphasize is that millions and millions of market participants are meeting in the market every day, and they're voting with what interest rate they'll accept. And so a lot lower risk than some of the best companies in the country is what the market's saying.
Absolutely. And I have to say one more quick note on that. I do think that investors are being sold fear by news outlets. And you have to be very careful because those news outlets, they thrive on you being afraid, and they sensationalize a lot of the numbers and a lot of the things, and they try to really make you watch because they trigger that emotion in you. And if you feel like, I'm afraid, I better watch this so I can get a sense of it. A lot of what I see and hear in the media is more or less fear mongering for the benefit of those news outlets. And I've been, and I'm not one of the guys to jump on the bandwagon, the fake media and all that. I don't believe. I mean, I think media has an important role, but I think it's also important for you as a listener to know there's a distinction between media being there to advise you versus entertain you. And I think that what media really truly does is entertain. So you have to be able to distinguish entertainment from advice. You get advice from Savant, you get entertainment from the media. And it's sometimes poor entertainment, but I'm not here to judge their entertainment value. I just think that be careful with the fear that's being sold by the media.
Yeah. One more thing on the debt. Is there any situation or context where the U.S. would ultimately have to repay this $34 trillion in debt?
Well, eventually, yes, it will have to repay, and we've done that in the 90s when we collected more in taxes than we paid. Partly because the economy was booming economy, and partly because we had sufficient tax base. For whatever reason, in the 90s, we did that. So we start repaying the principal. But it is something that the government can't keep pushing out there. And it can do so as long as people believe that the government has the ability to pay interest. Now, if it gets to a point that's so tremendous that like, then it might be a problem. But right now, if you look at historically, there were times that we actually repaid that principal, and typically because of sufficient tax receipts that came in, so it is possible that this can also revert at some point. But technically, yes, the government will have to repay, and you would have to have enough, new borrowers lined up to buy the new bonds to pay off the old ones. But it hasn't been the case.
Refinancing the debt.
It's refinancing the debt, pretty much. That's what the government is doing.
Got it. All right, let's talk a little more. We were big picture on the debt and kind of how we look at it from borrowing money. Let's go a little more specific to industries or companies. So the government can implement some very specific policies that could help or hurt an industry or a company. How should investors pay attention to these policies to take advantage of opportunities or avoid a potential loss?
Yeah, and I'm hearing this a lot, and it's a very legitimate question. When an administration comes in, let's say that they would favor one industry or another, should you make a move with your money, either to take advantage or perhaps protect yourself from losses? And I think it's a very seductive narrative. And here are the punchline. There are two things that we found as investors thinking about this particular type of strategy. The first thing that we found is that when you buy ownership in company, in any company, it's about the expected profits that you make. And what the stock market has gotten exceedingly good at is forming an expectation about those profits, either going up or down, depending on the government policies. And in fact, reflecting that in the price very, 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 very quickly, even before those actions are taken. In other words, Dennis, if you see that it's a sunny day today, but you see the clouds and the rain coming on the horizon, well, you tend to get an umbrella before the rain even comes. And that's what the market does. And the opposite, if it's rainy and you see the sun is coming, well, get the sunblock. And I think that's what I'm trying to suggest. The one thing that we found is that today, because it's so competitive in the stock market, prices tend to adjust incredibly quickly to any new expectation of additional benefits or a potential downside. And that is sometimes called the efficient markets. And today it's become even more important than ever to pay attention to this. And why does it matter? Because if you think a certain industry is going to benefit, by the time you read those words, the prices might have moved up into any one particular company. So if you start buying it and say, I'm going to buy it now, by then you're paying a pretty high price. And it begs the question if it's still a good deal. The second thing that we learned is not just that the expectations tend to be priced in early, but also that each individual company has other factors that might impact its performance beyond what the entire sector might be affected by. And let me give you a couple of examples on these 2 points. Back in the previous administration, there was a discussion about let's bring back domestic manufacturing. And one of the industries that got kind of honed in on was steel. And it turns out, Dennis, there's a company that carries the name of the industry. It is called United States Steel Corporation. And in the 2017 period, the stock price was kind of taking a dive for U.S. Steel. And then the administration started talking about potential tariffs. And those tariffs would have, given a competitive advantage to U.S. Steel, but there was no clarity. There was absolutely no clarity that those steels are duties and tariffs are coming. But on expectation, perhaps the stock price started to go up. Again, with no clarity, just an expectation. And in fact, in March of 2018, we did have tariffs that were announced for foreign producers. And at that point, clearly, U.S. Steel had a very big competitive advantage in the marketplace. So if you, as an investor, got caught up in that seductive narrative that, look, the U.S. government has now imposed steel tariffs, this is a really good time for me to invest in steel, what would have happened with your money? Well, between when the tariffs were announced and the end of the previous administration, U.S. Steel pretty much lost the majority of its value. It would have been a disaster, a complete disaster, if you had followed that seductive narrative and you bought U.S. Steel. So just because the government got behind it and their tariffs didn't translate into investment success. More recently, the big initiative has been about green energy. And if you look at solar panels, that's an example of what the current administration has been supporting. And Dennis, 3 years ago, I wanted to put solar panels on my house, and I got a few quotes, and I looked back, and one of them came from a company called First Solar. So when I recently looked at First Solar, what I found is that over the course of this current administration, about 3.5 years or so, First Solar more than doubled in price. So you'd have doubled your money in First Solar over the past 3.5 years, which is a really good outcome for an investor. And the other company that I looked at and got bids from was actually a different one called Sunrun. And over the exact same time period, Sunrun lost 75% of its value, even though they're pretty much neck and neck at the beginning of the period. And yet one company doubled in value, the other one lost 75%. So it wasn't clear that the industry as a whole benefited. And that was the second point that I made, that each individual company might have a different outcome. Now, what if I ignore all this noise and I kind of stuck with a diversified allocation and I bought some companies in an industry that is not favored by the current administration? Fossil fuel comes to mind. If you look at ExxonMobil, in the same exact 3.5 years since the Biden administration has been in office, it more than tripled in value, more so than First Solar. So this idea that somehow you ought to pay attention to the government policies and either buy or not buy certain companies is just not holding up when you confront with data. So because of that, I don't know that. In fact, I'm quite certain that government policies should not form the basis of an investment decision.
There seems to be a lot of turmoil around the world, from the war in Ukraine to the Middle East conflict. Even back at home, we have some unprecedented political developments, including a significant immigration problem. How are these events and uncertainty they bring impacting the market, and what actions should investors take, if any?
Yeah, and for sure, there's a lot of going on right now, and you have the war in Ukraine and the Middle East conflict that's escalating, and people are nervous, and that's understandable. Partly because you look at those images, it's kind of hard to believe that There's so much conflict going on at the moment. I'm kind of go back to one of the earlier comments that I made. Whether it's politics or global events, what the stock market is evaluating every single second is what is the impact on earnings and profits for different companies based on what is going on in the world at the moment. And what we find is that two things. One is that quite often a lot of these events don't impact global companies as much as one believes, because Ukraine and Russia, for example, those two are in a part of the world where their economies combined amount to about 2% of the value of the global economy. It's not that meaningful, and they don't trade the rest of the world to begin with. They never did. They're kind of isolated. So very limited impact, and the same with the Middle East. When you look at Lebanon and you look at in Israel and Gaza, for that matter, they're not really West Bank. They're not really big hubs. And how much is Apple selling in Gaza and the West Bank? So it's not as meaningful of a market there. Whatever impact on sales and earnings, there is not as meaningful. Nvidia, for that matter, or Google or Facebook. You think of Coca-Cola, McDonald's, they're not really being impacted. And that's what the market is reflecting right now, is that a lot of these geopolitical events, they might be very emotional in nature, but when it comes to the bottom line of different companies, they're not as impactful. The second thing that I want to convey to folks is that there's absolute geopolitical risk, and this is different perhaps than we've seen in the past. The same way that a game of chess ends up in a different position. Every time you play a game, it's always going to be different. You end up in a different position. You never end up in the same situation. The same way that the events today are perhaps different that we've seen. But in chess, Dennis, there is a fundamental premise that stays the same. You have a chessboard, 64 squares, 16 pieces on each side. So in this geopolitical world where this particular situation is different than others, what would be sort of the chessboard of investing, the one element that kind of stays consistent irrespective of the state of the world? And to me, the one element that gives me confidence is that in the US and pretty much the majority of the markets where we invest, pretty much all the markets, there is free enterprise and companies operating free markets, and they're free to pursue their economic gains. And they're going to try to figure out, if you give the markets and companies the ability to adjust, that they will adjust to whatever circumstances are present at the moment, and they're going to try to make the best out of those. And to me, the example that always came to mind is that if you look at World War II, and if you're brave enough on September 1st, 1939, to invest in the U.S. market and said, I'm going to listen to my advisor and actually invest in the U.S. market, by the end of the war in August of 45, the dollar invested at the beginning of World War II, talk about a different period, would have pretty much doubled actually over that 6-year period, despite the war. So how come? It's not because war is good for business. It's because companies adjust. And if you look at those days, when Cadillac couldn't sell their cars, they put the engine into a tank, and they actually sold a Cadillac tank to the U.S. government. I'm not sure if it had leather seats or not, but when Ford couldn't sell their Model T, they made airplanes and sold them to the government. And if you think of the build Ford tough, well, the toughest Fords ever built were not the F-150, where the tanks they made and they sold to the government. So to me, this idea that we are in a geopolitical situation that perhaps is different than other times. And the two things to consider is that what is the impact of the events right now on different companies, and then secondly, that companies tend to adjust. That if there's a hurdle in front of them, they're going to try to figure out a way to still make money, and that's exactly what we've seen over and over and over again through the course of the economic history of the country and the world.
Right. All right. So we've talked a lot about how geopolitical events cause uncertainty. Let's talk a little bit about elections. They definitely will inject a lot of heavy dose of uncertainty in an election year. So how do markets perform during election years? And are there indications for investors to stay disciplined, or is there indications that maybe they should sell and wait on the sidelines for the election result to occur?
Well, absolutely. And it's as you said, there markets supposedly don't like uncertainty. There's more uncertainty injected by the election should he do something. And in the spirit of the data that we talked about, we looked at the numbers, not kind of an opinion, but look at what does the data suggest. And the way we measure the performance of the market is a group of the largest 500 companies in the U.S. market. That's called the S&P 500. And we have good data going back to 1920. So over the course of these 94 years or so, we have had 24 different presidential elections. And when you look at them, the first question would be, well, what percentage of these years did the market go up or down? And do we see a clear indication that perhaps, if the markets do go down significantly in these presidential election years, then maybe we ought to be concerned. And when you look at the data, what you see is that 20 out of the 24 years, the markets actually go up. They have a positive return. The S&P makes you money in these 20 years. So you do go up in value, which is quite interesting because that's 20 out of the 24 years. But there are 4 years, so it's not every time, but 4 years the markets do have a negative outcome where you basically are your account value would drop. So Dennis, what's interesting is that as an investor, when you look at the numbers, the overwhelming majority of the time, the market tends to go up in an election year. Not every year, but it does go up. No idea what's going to happen this year. But when people are saying, well, this is a different election and it's more nuttiness, I'm going to go back to 2020 because it's the last election and it's not that far off that we can still remember what happened in 2020. Not only that we had a pandemic, but from an election perspective, we did not have the two presidents sit down next to each other and transition power in the US, which is unprecedented. They never sat down to basically transition power. It went all the way to insurrection at the Capitol. So when you're talking about a different election, well, that was certainly different, and the whole year was different. And yet, even in that year, the market went up by about 18%. So just because it's an election year, I'm not sure that I would be terribly concerned just by that fact alone. But we do have 4 years when the market did drop. And Dennis, I thought it might be interesting to look at each one of those to see what we can learn. And in 1932, the market did drop. We had an election, but that was also the year of the Great Depression. So yes, we had the election, but also the Great Depression. What might have mattered more for the markets? And in 1940, we talked about the World War II. That was just getting started. So obviously, what mattered more, the war or the election? And then it took 60 years until the next time that we saw an election with a negative market outcome. That was in 2000. And if you remember that image seared in my mind, the gentleman in Florida looking for the Chaz little openings in the ballot. And you can say, well, that wasn't good. On the other hand, 2000 was also the beginning of the dot-com bust. Pets.com and all the other big tech stocks kind of come crashing down. And the last one was 2008, which is Obama versus McCain. And yet that was also the year of the financial crisis. So I think it's so interesting, Dennis, that if you look at the 4 instances when the market dropped in an election year, in every single instance, there seemingly was something a lot bigger going on in the world rather than just the election itself. So to me, again, what it basically tells me is that as an investor, I don't see a sense of panic just from the fact that it's an election year, not at all. So you don't need to sell, move to Canada, just stay put because it doesn't seem like that particular election itself has a major impact, negative impact on the market.
So we've looked at election years. What about during presidential administrations? We have different administrations with different stated policies or priorities. I mean, how have markets performed with these different presidents and their various agendas?
Absolutely. So we looked, and in this case, I went back in my lifetime. I'm born in 1969. So there are 9 presidents with completed terms. And in my lifetime, Dennis, the stock market, this S&P 500, has grown at about 10% per year average annualized, which means that if you start with $100, you make 10% in the first year. So now at the end, you have 100 plus the $10 in earnings. You have about 110. But then you start the following year with 110, and then if you make 10% of that, that's $11 plus the 110, then becomes 121. So you keep growing your money at what's this called average annualized return. So I wanted to see, if I start with this yardstick of about 10%, how did the markets do during different presidents, and kind of look at that average annualized during their time in the White House. So when I was born, President Nixon was in the White House, and for about actually it was about 5.5 years that he was in the White House. What you saw is that the market went down by about 2.9% average annualized per year instead of going up. And then for about 2.5 years, his vice president came along, Jerry Ford, and the market skyrocketed at over 20% per year. And in 1977, he lost to Jimmy Carter, and on average for 4 years, right there, Georgia fella, markets went up by 11.7, a little bit above average, followed by Reagan in the 80s, President Reagan in the 80s, 15.8. And then we had his vice president, one term, George H.W. Bush, once again above average, followed by the 90s with President Clinton, 17.6. And then we had the Bush versus Gore election. Markets dropped by about 4.4% annualized per year. And then we had President Obama and then President Trump. And, what I want to do, Dennis, is basically just, leave this data up and ask folks, and I've asked this question all over the country and over the world, is there an obvious pattern that tells you that having a Republican or a Democrat is better or worse for the markets? And the answer is there's no such pattern. Nobody could tell me that there's such a pattern. Now, what about this idea that you have some presidents that have policies that are better or worse? And you hear a lot about tax cuts. Well, what if I tell you there's a president that cut taxes specifically to dividends and capital gains in the stock market? It ought to have been a boon for the market. And it turns out that president was George W. Bush. And yet, even though despite those incredibly business-friendly and market-friendly policies, the market dropped. How come? Well, he came in just as the dot-com was going bust, something he had nothing to do with. And then he had a 9/11 9 months into his term and walked off at the bottom of the financial crisis. So is it fair to say that he was not a good president for the markets? I don't think so. On the other hand, President Clinton came in just as the dot-com started to take off and left before it started turning. So you can say, well, he was a good president for the markets. Again, I'm not sure how much he had to do with the companies in the Northwest or Silicon Valley that were taking off, like Amazon and so forth. Now, what about policies? And somebody can point to President Reagan, a very business-friendly tax cuts. The market reacted really well. On average, during the 8 years in the White House, it went up by 15.8%, which is a very solid result. I remember when President Obama was running, people were concerned that having a person focused on social programs would not necessarily benefit the market. And in fact, that's the time to sell because it's going to be a bloodbath. Well, during the 8 years of the Obama administration, whose major accomplishment is healthcare for the country, the markets went up by 16%. How different is 15.8 from 16? So it does not appear that any one president, any one set of policies is really driving the stock market, despite what I can think people want to believe that's a direct link. We just don't see in the data. We just don't. Whether it's tax policy, whether it's economic policy, the markets don't seem to be driven by agendas of presidents.
So what about Congress? They're also in play this fall. We know the legislative branch plays an important role in setting federal policies. How should investors consider, both sides of these elections, and which scenario does the data suggest is better for stock market?
Absolutely. No, what's interesting is that when you think of the White House and Congress, there are different ways that you can split it. They control this, but not that. And then it's like, it gets complicated. It's like splitting hairs, which I don't have any. But what was interesting, Dennis, is 3 years ago in 2021, right there in Georgia, there were 2 Senate races that the Democrats won in January. And when that happened, to me, it occurred that we can actually run a much more natural experiment in which you examine times when one party is in full control of the White House, the Senate, and the House. So there's no place to hide. You control everything, and you can look how the market did when we had one party in control versus the other to really get a sense of which party might be better for the market. So when you go back to 1920s, the Republicans had 13 years of this single party control, where they controlled the White House, the Senate, and the House at the same time. So if you take these 13 years, you look at their returns and you average them out, it turns out that on average, the market went up by 14.52%. The Democrats also had this unified government control, but it wasn't 13 years. In fact, it was a lot longer, 34 years. So the question is, how do the markets do in that case? And I knew that 3 years ago that somebody's going to look at me and say, "Look, you're trying to promote one party or another because you data mining and whatever it is." I'm just going to share the numbers. And in fact, to make sure they're very accurate, we engaged the PhDs in the research group to double check. And it turns out that during the 34 years, so more years of the Democrats being in control, during the 34 years of the Democratic unified government control, the markets went up on average by 14.52%. Then it's crazy. It's identical to the second decimal. It's identical to the second decimal. So when people are saying that, one party is better or another, it's just not in the data. It's identical to the second decimal. And I do think that it's all emotions that people want to portray. They want to believe one thing or another. It's not in the data. It just does not appear that as an investor, you ought to make a move with your money solely because of the election outcome. Because whether it's Democrats or Republicans, remember this number, 14.52, identical to the second decimal.
That's a crazy number.
Yeah.
So I mean, all the data you've shared with us suggests that politics and elections don't seem to make a big difference for investors in their stock market performance. That's not what most people believe. So
Yeah.
why do you think that is the case, and how should investors ultimately think about politics and their investment decisions?
Absolutely. And I think that so many people are really driven by their emotions and their views about the market rather than by the data. And I think it's natural. You just have to be careful to acknowledge those emotions. And all the data that I've shared with you, it doesn't necessarily mean that politics and elections don't matter. But of course they matter to some companies more than others. What I'm here to suggest is maybe a little bit different, something a little different. What I'm here to suggest is that politics and elections are one of the many, 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 many variables that impact the performance and the outcome of any one company and the stock market as a whole. It just doesn't appear to be a primary one that you can link the outcome of an election with what the market's going to do. You can't do that because the other variables might be more meaningful. And maybe, Dennis, I'll wrap up with the analogy that I've always kind of thought is interesting is I bake cookies with my daughter. And when you put in the eggs, the sugar, the flour, the butter, you mix it all in, you put the cookie in the oven. When the cookie's baked and you break it apart, you can't really point and say, aha, I recognize the egg yolk in there. No, you can't. It's mixed in with so many other ingredients that it becomes indistinguishable. And that's what elections and politics is the egg yolk in a cookie. It's somewhere in there. You can't really distinguish it. And you ought not to build a strategy built around the egg yolk. But the good news is that it's not the garlic in a cookie. It doesn't stink it up enough to recognize it. So because of that, think of it as one of the many, many, many variables that impacts the performance of a company. It's just not a primary one. And because of that, we don't recommend that investors make decisions with their money based on elections and politics, but rather that financial plan that I talked about earlier. That financial plan was built to withstand the uncertainty, and we believe strongly that you're better off sticking with that plan rather than letting those emotions drive your investment decisions.
Great advice, Apollo. Really appreciate all you've shared with us today. The data is very compelling, and I think, as you said, it's not something most people believe. So it's good to have that reinforced. So That's all the time we have for today. Paula, really thank you for being with us, and you did a great job of being the secretary of explaining stuff. So
My pleasure. Great seeing you.
Good to see you too. If at any time you're looking for more information about Savant and what we do, I invite you to go to savantwealth.com to learn more. We appreciate your time today and look forward to speaking with you soon. Thank you.
Bye-bye.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.